Hey Bowtie Nation, Joseph Hogue with your weekly stock market update coming to you on Sundays at noon before the week starts with the stocks to watch and the stock market news you need to see. And Nation, we are seeing the next inflection in AI stocks unfold. And it's not slowing down with one group up almost 100% in just 6 weeks. What happens next could make the 1500% return on Nvidia look tiny. I'm decoding the 99% return in the hottest AI ETF to pick out the top 3 stocks to buy right now, along with an important update to shares of Nvidia ahead of its earnings this week and our stock market outlook. First, though, onto that AI ETF because the Roundhill Memory ETF, the DRAM, is up 99% in the 6 weeks since launching, the fastest fund ever to $6.5 billion in assets, and double your money in less than 2 months. This fund launched at the perfect time to take advantage of the shortage in memory and storage components, a critical bottleneck in the AI infrastructure buildout, with 9 stocks in the group producing that RAM, SSD, and the high-capacity HDD memory into those AI data centers. Some of these stocks are up nearly tenfold just in the last year. Micron, ticker MU, up 714%. Seagate Technology, STX, up 665%. Western Digital, WDC, up 894% over the last year. And yet, the upside is not over for these AI picks and shovels plays. A new study finds 57% of companies have an AI agent program in production, with 1 in 4 large companies spending more than $5 million a year to develop one. AI model maker Anthropic reported an 80-fold increase in usage over just the first 3 months of this year. Not 80%, that is 8,000% increase in the compute demand for its models in just 3 months. That is the demand driving the trillion-a-year spending to build out AI data centers, along with all the hardware, the networking equipment, and the memory that goes in one. Just the 4 major hyperscalers, that's Alphabet, Meta Platforms, Microsoft, and Amazon, will spend $725 billion this year on AI and are increasing their spending 35 to 60% a year. And while the Roundhill DRAM ETF gives you a focused bet on that memory hardware, it's not the full picture and it's not going to help you find that next bottleneck in AI spending. For that, I want to reverse engineer the 3 biggest AI stock ETFs, show you the stocks in each, and pick out the very best for your portfolio. Besides the DRAM fund, we'll also be looking at the Wedbush AI Revolution ETF, the ticker IVES, a fund of 30 companies positioned to benefit from that AI transformation. The fund is up 16% this year with many of the biggest names, including Advanced Micro Devices, AMD, Micron, Broadcom ticker AVGO, and Nvidia, but unlike the DRAM ETF, not nearly as focused. Many of the stocks here, like Apple and Shopify, may have some relationship to AI, but aren't necessarily the pure play investments into that infrastructure spending boom. We'll also be digging into the Wedbush AI Power and Infrastructure ETF, the IVEP, which holds 30 stocks in the data center power generation, another critical bottleneck for the industry. Again, though, while all of these relate to the theme in some way, there are some, like NextEra Energy, ticker NEE, where data center power generation is such a small part of the total, and Williams Companies, ticker WMB, in the pipeline space that they aren't the kind of focused investments we want for an AI stock portfolio. Now, those tangential stock ideas may be good companies and can be fine stocks, but if you're looking for the kind of triple-digit returns coming from that AI infrastructure buildout, you need to focus on these pure plays in the space. Back to the Roundhill DRAM ETF, the most focused pure play of the 3 with just 9 stocks, and only 4 of these are available in the US markets. That's Micron Technologies, SanDisk, Seagate Technology, and Western Digital. For that reason, you might still hold some shares of this fund even as you pick out the individual stocks from the other 2 funds, so you get that access to some of these foreign memory names like Samsung, SK Hynix, and Nanya Technology. Among the US memory stocks here, SanDisk, SNDK leads in growth with analyst forecasts for 112% revenue growth this year, followed by Micron with 89%, Seagate 35% growth, and Western Digital with just 10% growth expected. That growth, that is the key here to these stocks that have already run triple digits in a very short time, finding those where the growth still justifies these higher valuations. That's because all of these are trading well over their long-term price-to-sales valuations, with Seagate the most expensive at 15.8 times valuation, so investors are paying $15.80 for every dollar in revenue generated by the company, followed by SanDisk at 15.3 times, Micron at 15 times, and WDC at 14.3 times that price to sales. Adjusting for that sales growth, though, taking the price to sales valuation divided by the growth in those sales, we get an adjusted valuation to find the best buys in these. And it's doing this that we see SanDisk, even after a 3,200% return over the last year, is still the better buy on that adjusted valuation. That's that 15.4 times price to sales divided by the 112% growth. That is just 0.14. Now that's going to be followed by Micron, 0.17, which is still a very good deal, Seagate, 0.45, and Western Digital, a distant fourth at 1.35 on that price to sales adjusted for growth. I'll dig into those other two ETFs and highlight two more stocks to buy next, but I also want to highlight a special offer on the site I'm using here. I've used Seeking Alpha Premium for years to get analysis and ideas along with the comparison feature I'm using in this video. You'll also find pre-built stock screeners for top-rated stocks, dividend yields, and growth stocks, and you'll be able to sit in on a company's earnings report to get that inside information. Look for the link I'll leave in the description, and you'll be able to try premium access, risk-free for 7 days. If you like it, that link is also going to give you a promo code for $30 off the regular price, so make sure you check out that link or just scan the QR code here. The Wedbush AI Revolution ETF, the IVES, is much less focused, and in fact, a lot of these I would barely consider AI related. Here, Apple might benefit from AI eventually, but it is so far behind that it likely needs an acquisition to fill the gap. Others here, like IBM and Salesforce, may benefit from selling their AI agents, but are also at risk of AI eating into their software sales and aren't the kind of hardware or cloud infrastructure plays that we're looking for here. So within the fund, I would focus on the chip makers here, that AMD, Nvidia, Broadcom, and Intel. Now, on expected revenue growth, Intel is still just a dream at 7% sales growth expected, but the others here, the other three, are forecast to post between 43 to 55% revenue growth over the next year. That helps to bring valuations back down a little, though these stocks have gotten very expensive, with Broadcom trading at 30 times price to sales, followed by Nvidia at 26.5 times and AMD at 19.5 times price to sales. For example, we were buying AMD last year in January when it was just 6 times price to sales and have seen over 170% return on those shares. Now, adjusting for that revenue growth, AMD is still the least expensive here, though not by much, at 0.46 times versus Nvidia, which is trading at 0.48 times price to sales adjusted. Now, considering the much higher profitability at Nvidia with an EBITDA margin of 61% versus only 20% at AMD, I think I'd go with Nvidia here instead. It's only slightly more expensive, but is converting that growth into earnings at a much higher rate. The Wedbush AI Power and Infrastructure Fund, the IVEP, is the least focused of the three, mostly because so many of these energy providers get a much larger share of their revenue from other customers that AI component isn't a big driver on earnings. For example, even though data center revenue grew 42% at the Southern Company, that's ticker SO, last year, it is still a tiny fraction of the $31 billion in total sales that are only growing at about 5% a year. Now, power generation is a big AI bottleneck, but you want to focus on these smaller companies here that are dedicated in that AI theme, like Bloom Energy, ticker BE, Vertiv Holdings, VRT, Quanta Services, PWR, and Coherent, COHR, and Monolithic Power, MPWR. Revenue growth in these ranges from just 18% for Quanta Services, which still sees a lot of its revenue from those other industrial users, to 61% forecasted growth at Bloom Energy, which is all in with that on-demand power for data centers. But then the valuations largely track that growth on these, with PWR the least expensive at just 3.8 times price to sales, and BE the most expensive at 31.4 times its revenue. So it is extremely important here to adjust these by growth to still find that best relative deal. Here we see that Quanta Services still comes out as the least expensive on that adjusted basis at 0.21 times that price to sales adjusted for growth. Now, optics maker Coherent is also a good deal at 0.40 times, followed by Vertiv Holdings 0.44, Bloom Energy 0.51, then Monolithic relatively expensive at a 0.98 times on that adjusted valuation. Now, like I said, I would still hold some of that DRAM ETF to get access to those foreign memory stocks, but then focusing on the best deals in SanDisk, SNDK, Nvidia, NVDA, and Quanta Services, PWR, for that pure play AI portfolio. Now looking at the stocks I'm watching this week, Nvidia, ticker NVDA, will be the big news of the week when it reports earnings on Wednesday. CEO Jensen Huang accompanied the president to the China summit last week, and the US finally approved the sales of the company's H200 chips to 10 Chinese companies. The news saw shares up more than 4%, but is even more important for what it could mean this Wednesday. Nvidia almost always beats its revenue and earnings forecast, so it's the outlook that matters most here. And now, Huang is going to be able to talk up those coming orders, possibly even upgrading the next quarter's sales growth targets past that $87 billion forecast. It would also go a long way to meeting its full-year revenue targets for more than $371 billion and a 72% growth from last year. Again, comparing Nvidia against those semiconductor peers, AMD, Broadcom, and Intel, company remains the undisputed leader with that 55% sales growth expected over the next year versus just 45% for Broadcom and 43% for AMD. That sales growth helps to put the valuation into perspective and makes Nvidia the better buy hill. That said, after a 74% run in the shares over the last year, the stock has not fared well on its earnings reports in the past. Despite beating earnings forecast by an average 5% over the past 4 quarters, the stock has fallen 3 times out of 4 on its earnings days, including a 5.5% drop last quarter. Now, I still like the upside on that potential for Huang to talk up those coming sales to China and would be definitely buying on any dip. Home Depot, ticker HD, also reports earnings Wednesday, with the stock down 11% so far this year and likely to echo Whirlpool's disappointing assessment of the consumer, noting that customers were pulling back on those big ticket purchases given uncertainty around inflation and the war. The company is expected to report 4% sales growth for the quarter, but there is a good chance we see management pull back on that full year forecast for 4% growth in light of that consumer trend. The downside to the stock may be marginal since the price has already pulled back to a discount on its long-term price multiples. Shares trade for about 22 times earnings and 1.9 times sales, both of which are quite a bit lower than the average valuations over the last year, but any downgrade in that outlook is going to hit these shares. Home Depot has seen shares up in 2 of the last 4 earnings dates, though the stock did fall 6% on the third quarter report last year. Options pricing on the shares show the market expects about a 4.6% move on this report, but it could be much higher on that revenue downgrade. And Walmart, ticker WMT, is going to be the ultimate measure of consumer health when it reports earnings on Wednesday as well. Shares have fallen in 3 of the last 4 earnings reports, but something I've noticed lately may help the company beat its expectations. This is just anecdotal, but I've noticed local Walmarts underpricing their gasoline even more than usual since prices started increasing late February, sometimes by as much as 30 cents a gallon less than the other stations. Now, I think it is a strategic move by Walmart, pulling people in when those gas prices are the biggest costs on their minds and hope they stay to shop grocery and other items. That could go a long way to helping the company meet its 6.5% expected revenue growth for the quarter and 6% forecast for the full year. I'd be paying attention to the profitability and the earnings growth if the company is using that gasoline segment as a loss leader, but it could help surprise revenue on the upside. Updating our stock market outlook without any major economic news and with earnings season winding down, we're going to answer a very important question this week. Does the market need good news to keep stocks moving higher? I showed a few weeks ago how stocks, then with the S&P 500 at 7,100, were not expensive, and even at 7,500, the market isn't quite overpriced. On forecast for earnings of $334 for those 500 companies in the index this year, and that $7,500 index price level, that is still only a price of 22 times its earnings. That is right around the 10-year average valuation and well under the 28 and even 30 times PE ratio stocks have hit in the recent past. So stocks are not so expensive that you'd expect profit taking at any moment, but anytime the market jumps almost 8% in a month and 18% just in the last 6 weeks, you get a sense that things are priced to perfection in that short term. Now, over the last 2 months, investors have had that constant affirmation, with companies reporting 27% earnings growth, which is unheard of overall, and with 84% of those companies beating their forecasts. Now, with that kind of growth, investors have been able to overlook growing inflation, a simmering war, and a weakening consumer. But we did hear what could be a very important warning from Whirlpool's CFO earlier this month, that consumer confidence has nosedived, and the appliance maker is seeing a big shift in people reducing those big ticket purchases. We saw last week that consumer prices jumped 3.8% from last year, and even worse, wholesaler prices were up 6%, a sign that that higher inflation is going to continue to work through the supply chain and push those consumer prices up in the months to come. So the idea here is without earnings to boost sentiment, some of those problems are going to come home to roost. With the Strait of Hormuz blockade freezing 20% of the global oil supply and inflation creeping higher, and with Iran evidently in no hurry to negotiate, It raises the possibility of US renewing strikes in the near future to try to break this stalemate. What this all comes down to is investors have very little to look forward to in terms of good news over the next few weeks and a steady stream of bad news that could lead to one of those regular 5% corrections we get every year. Now, that doesn't mean you sell all your stocks, but it might mean a little protection can go a long way. With the S&P 500 ETF, the SPY at $747 a share, I can buy the $745 puts that expire June 18th for $12.25 each, while selling the 740 strike for $10.45 each. Now that means I pay just $1.80 a share for that put spread. If the S&P 500 falls just 1% over the next 5 weeks, the spread is going to be worth $5 a share for a 177% return, which can go a long way to cushioning those losses in individual stocks if the market does fall. Now again, folks, there is nothing wrong with just sitting tight and holding your stocks. I still like the rest of the year for those returns, but there is also nothing wrong with taking these opportunities to protect yourself on a little short-term downside. Use the link in the description and try Seeking Alpha Premium risk-free for 7 days, plus get a $30 discount to your subscription. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.